Google just raised money for the first time since it went public. $80 billion in new stock plus fresh debt, all for AI. Amazon, Microsoft and Meta are stretching the same way. These four hyperscalers are about to spend $740 billion this year, and even that might not be enough to build the capacity in time. One US state has already stopped new data centers completely, and at least 10 more are considering the same thing. Amazon, Microsoft, Alphabet and Meta are all spending at a scale that has never happened before, and that's the single most important number in the market right now. I will show you how much each one is spending, how they're paying for it, and what happens to the whole market if they slow down. Right now we have what people call a K-shaped market, where one industry goes up while the rest of the market goes nowhere. AI stocks have been flying this year while a lot of other stocks are just sitting flat or down. That whole split comes down to one thing, which is how much big tech is willing to spend on AI, and it keeps growing. For 2027, Morgan Stanley sees more than $1 trillion of CapEx, so this is the engine holding up the entire market, not a side story. But there is a crack forming. The cash these companies bring in is not growing fast enough to keep up with the spending. And once you go through them one by one, you can see the pressure building. Let me start with Alphabet. Revenue is up 24%. Google Cloud is growing 82%, the fastest growth ever. Search is still growing. By any normal standard, this is an excellent business, but the stock fell after the last earnings report. They raised their spending forecast for this year to $205 billion, up from $190 billion. Capital spending in a single quarter more than doubled to $45 billion, and free cash flow went negative for the first time since IPO. And this is where that cloud number gets interesting. 82% growth sounds spectacular, but the actual dollars are nowhere near enough to fund this. Cloud revenue was $24.8 billion last quarter. CapEx in the same quarter was $45 billion. So they spent almost twice as much building new capacity that will bring revenue in the future. And this is where it gets ugly. Google doesn't generate enough money to cover the CapEx. Until now, Google was famous for buying back its own shares. Last quarter, they paused the buyback, raised $80 billion in new stock, and increased their debt to over $100 billion. When Google goes from buying back stock to raising fresh money, that tells you how heavy this cycle is. By the way, you can check those numbers yourself with Stockpicker. The platform has free trial, no credit card is required. Amazon is spending $200 billion this year. CEO Andy Jassy keeps repeating that AWS is sold out and they cannot build fast enough to meet demand. AWS is only about 18% of Amazon's revenue, but it brings in more than half of the company's profit, at margins above 35%. It is the engine that pays for everything else. So they're chasing that cloud revenue as hard as they can. But Amazon has another problem. Their retail business already burns a lot of cash on its own, so even with AWS bringing in money, it is not enough to cover all the new data centers. Amazon is turning to the debt market instead, and you can see directly on the balance sheet. Amazon's long-term debt jumped to $210 billion in the first quarter. This was up from around $153 billion the quarter before. That's $57 billion of new debt in a single quarter. They raised $54 billion in bonds earlier this year, then came back in July for another $25 billion. Now, I would not call this a red flag. Amazon is using cheap debt to build assets that earn high returns, instead of printing new shares and diluting the shareholders. It pushes their free cash flow down for now, but in return they lock in cloud customers for years, and that's a trade they're happy to make. Microsoft was supposed to be the winner of all this. Instead, it is the worst performing stock of the four. 3 years ago, everyone called Microsoft the clear AI winner, as they were the first mover together with OpenAI. Now the mood has flipped and the stock is down about 21% this year. Microsoft still generates more free cash flow than any of the four hyperscalers. And even that is not enough. Free cash flow is around $70 billion a year, and the spending plan is $190 billion. To pay for that, They are trimming costs in other areas and borrowing from the markets. Every dollar they pour into new data centers drags down their return on invested capital, at least for now. For 2025, that number was 21.6%, but the chart already shows a downtrend, and a spending wave this big will keep pulling it down before it starts paying off. Now Meta. Meta grew revenue 33% last quarter, the highest of the group. That number tells you the AI spending is already working, because most of that growth comes from better ad targeting running on the same AI systems. Even so, the stock spent most of the year down. Investors were nervous about the sheer size of the spending, up to $145 billion, and they wanted to see it turn into something more direct. Then Meta announced Meta Compute. They're renting out the excess computing power to other companies, and when that news broke, the stock jumped 9% in a single day. The logic is simple. Instead of waiting on future AI products, Meta turns part of that huge spending into revenue today. And since Meta is the only one of the four without an existing cloud business, renting out the spare power is a smart and logical way to earn money on infrastructure they were building anyway. Now, you would think $740 billion buys all the AI capacity you could ever need. Well, it doesn't. And the reason has nothing to do with money or chips. Land and power access are now the hardest part of the whole build-out. Morgan Stanley thinks these four companies will add 34 gigawatts of capacity by 2027, which is enough to power 50 million homes. Building that kind of power supply takes years, and it doesn't speed up just because the money is there. A large part of the spending goes into power sites, land, and cooling systems that will not switch on until 2027 or later. All four have been signing deals directly with power companies to lock in the electricity. Meta has recently announced deals with Vistro Corp and Oklo, and the Oklo power is not even expected until sometime in the 2030s. And now regulation is stretching it further. New York just became the first state to pause new data centers with an executive order blocking permits for any facility using 50 megawatts or more for up to a year. Projects already approved can go ahead, but new ones wait. Lawmakers in 10 other states have put similar bills forward this year. So what could break all of this? It comes back to that delay. The money is spent upfront, but none of it earns anything until the facility is running. About half of this spending goes into land, buildings, and electrical work that sits there for 2 or 3 years before a single customer pays for any of it. Then the chips arrive and they can sit too. Microsoft CEO has said they had chips in inventory they could not plug in because the buildings were not ready for them. The risk is not that demand disappears. It is that all of this capital goes out the door years before anything comes back. And the market has already started reacting. Alphabet posted the fastest cloud growth in years and beat on revenue, and the stock still dropped, purely because of the spending number. That is the market saying it wants to see returns, not scale. This is what you need to understand if you own any AI stocks. Think about why names like Micron and SanDisk have run up so hard. It is not because they invented something new this year. It is because hyperscalers need their memory chips and can't get enough of them. Same story with MRVL, same with CRDO, same with the entire AI supply chain. Every one of those companies is priced on the assumption that big tech keeps spending at this pace. If spending slows down, there is nothing underneath these stocks to catch them, because they're not priced on what they earn today. They are priced on the expectation that this spending continues. Full disclosure, I own shares in Alphabet, Amazon, Meta, and Microsoft, so I have skin in the game. This video is for information purposes only, it is not financial advice. Always do your own research. And if you like this video, I'm sure you will like this one where I break down Amazon's robotics strategy.